Why is $1 not the same as £1 or 1 yen? A dollar, a pound, and a yen are all just pieces of paper or numbers on a screen. So why isn't $1 worth the same as £1 or 1 yuan? It seems random. But currency value isn't about the symbol printed on it. It's about what that currency can actually buy, and how much people trust the economy behind it. Every currency represents the strength of the country that issues it. When a country's economy grows, produces goods, attracts investment, demand for its currency rises. More demand means higher value. When an economy struggles, losing jobs, running huge deficits, or printing too much money, trust falls. Less trust means the currency weakens. Exchange rates shift constantly because economies are always moving. A dollar might buy you 100 yen today, but tomorrow it could buy 98 or 102, depending on what's happening in America and Japan. The value also depends on trade. If Japan sells more products to America than America sells to Japan, demand for yen increases. That pushes the yen's value higher. It's a global marketplace where currencies compete based on economic performance, trade balance, and investor confidence. A dollar doesn't equal a pound because America and Britain have different economies and different levels of global trust. Currency value reflects reality, not randomness. Why is every country in debt? And who do they actually owe? Every major country owes money. America owes over $36 trillion. But if everyone owes money, who are they paying? The answer is each other and their own citizens. When a government needs money, it borrows by selling bonds. A bond is an IOU. You give the government $1,000 today, and in 10 years, they pay you back with interest. Individuals, banks, other countries, pension funds, all buy bonds. So when America owes $36 trillion, it owes that money to American citizens. Holding savings bonds to China, holding treasury bonds to Japan, and to institutions managing global money. Governments almost never pay off the full debt. They keep refinancing, selling new bonds to pay off old ones. As long as the economy grows and people trust the country will keep paying interest, the system works. National debt isn't like personal debt. You can't repossess a country. Debt only becomes a crisis when trust collapses and nobody wants to lend anymore. Why can't we just print more money? If the government needs money, why not just print more? Create $1 trillion and solve everyone's problems. But money only works when it represents something real. Imagine your town has 100 people and 100 loaves of bread. Each person has $10 and each loaf costs $10. Now the government prints another $1,000 and hands it out. Suddenly people have more money, but there are still only 100 loaves. Everyone rushes to buy bread. Prices rise to $20, then $30. The money in your pocket didn't make you richer. It just made everything more expensive. That's inflation. Printing money doesn't create value. It dilutes value. When more money chases the same amount of goods, prices climb until the extra cash becomes worthless. In Germany during 1923, people needed wheelbarrows full of bills to buy groceries. A loaf of bread cost billions of marks. The money became wallpaper. Governments can print money, but only if the economy grows with it. Print without growth, and you destroy trust in the currency itself. You can't print wealth. You can only print inflation. What is Bitcoin? Bitcoin is digital money that exists only online. No coins, no bills, just code. Unlike dollars in your bank account, no government or company controls it. Bitcoin runs on blockchain, a public ledger that records every transaction. When you send Bitcoin, the transaction is broadcast to thousands of computers worldwide. These nodes verify it by solving complex math problems. Once verified, it's added to a block and chained to all previous blocks. Everyone can see the transaction, but nobody knows who you are. The system is decentralized, So no single entity can freeze your account or print more Bitcoin. There will only ever be 21 million Bitcoins. Scarcity is built into the code. That's why people call it digital gold. But Bitcoin has problems. Transactions are slow. The price swings wildly. And if you lose your password, your money is gone forever. No customer service. Bitcoin proves you can create money through math instead of trust in governments. Whether it's the future of finance or just a speculative asset depends on who you ask. What if inflation goes negative? Falling prices sound like a dream. But when deflation sets in, the economy freezes. If you know prices will be lower next month, you wait to buy. Consumers delay spending. Businesses cut prices further. People wait even longer. Demand collapses. Companies lose revenue and lay off workers. Unemployment rises. People spend even less. The economy spirals downward. Debt becomes crushing. You still owe the same amount, but your income shrinks. Defaults rise, banks fail, credit disappears. Japan experienced this in the 1990s and stagnated for decades. Inflation feels painful, but deflation is paralysis. Economies need prices to rise slowly. Movement keeps the system alive. Who really pays the tariffs? When a government puts a tariff on imported goods, it sounds like the foreign country is punished, but the foreign country doesn't pay. You do. An American company imports steel costing $1,000. The tariff adds $250 at the border. The American company pays that tax. The Chinese supplier still gets $1,000. To cover the cost, the company raises prices. That steel is used in cars, appliances, and buildings. The tariff gets passed down the chain until it reaches you. Tariffs are taxes on imports, and taxes always end up with the final buyer. Why nobody can afford a home anymore? 50 years ago, a single income could buy a house. Today, 2 incomes barely qualify for a mortgage. Housing prices exploded while wages crawled. Cities restrict new housing through zoning laws and neighborhood resistance. Supply is limited while demand keeps growing. Investors and corporations buy homes to rent or flip, treating them as assets rather than shelter. Low interest rates encouraged bigger loans, driving prices even higher. Millennials and Gen Z now face a market where saving for a down payment takes decades. Homes were once places to build a life. Now they're assets in a portfolio, and regular buyers can't compete. Difference between trading and investing. Trading means buying and selling quickly to profit from short-term price movements. Traders bet on momentum and news, watching charts constantly. Most lose money because timing the market is nearly impossible. Investing means buying assets and holding them for years or decades. Investors focus on long-term potential and compound interest. When the market crashes, traders panic. Investors wait it out. Both can make money, but they demand different mindsets. Trading is a sprint. Investing is a marathon. How rich people use debt to get richer. For most people, debt is a burden. For the wealthy, debt is a tool. They borrow against their assets to access cash without selling and triggering taxes. If their investments grow faster than the loan interest, they profit from borrowing. Average people can't access these low-rate loans against modest assets. Debt for the rich means leverage and tax avoidance. Debt for everyone else means high interest and mounting stress. The system rewards those who already have wealth. How money laundering works. Money laundering makes illegal cash look legitimate. It has 3 stages. First, placement. Getting dirty money into the system through small deposits or buying expensive items. Second, layering. Moving the money through complex transactions, shell companies, and offshore accounts to obscure its origin. Third, integration. Investing in legitimate businesses like restaurants or real estate, mixing dirty money with real revenue so it appears as clean profit. The financial system is so large and complex that illegal money can hide in plain sight. Laundering doesn't hide the money. It hides the crime.